time priority. So the guy who gets there first wins. And so all this has become really a fight over microseconds to try to figure out who gets there first.
So,
and that's kind of prefaces
what's time. What ends up happening is what we've started with is basically a model built on 1 then 2 exchanges. And as we've built up over time, the number of things that exchanges do has changed significantly. So exchanges today may be they're going to be routing orders. So we were just talking about this a little bit ago. What an exchange does today is very different than what exchanges used to do historically. And now exchanges actually have a number of ways that they make revenues. One is off of listing fees, and that's fine. One may be off of executions. But another major way that exchanges also can make some money is by selling essentially speed access. So data feeds, co-location and data, and those are other ways. That's something that has evolved over time with regulation in place. And so what's interesting about that is it puts an awful lot of priority is in a zero-sum market where you have the first in line gets hit and the first order in the book gets hit and the second may not. You always want to be first. Well, if you have more information faster, you're going to more likely be the first. So we essentially have what has turned into a speed race. A number of years ago, it became big news that someone had spent $200 million trying to blow up a mountain and run fiber optic lines to Chicago. Now it's became big news again more recently when they became microwave towers. And now actually we just recently, just recently in January, we had the approval of lasers because microwave towers were too slow. And so you can see that evolution. What's interesting about that is really focused on the mechanism of trading, not necessarily the mechanism of investing, right? So that is who's going to be to this particular spot first with the information to make a decision. What IEX has done is actually almost go in the exact opposite direction. And they have said, we're going to remove a lot of those speed advantages for this venue. And so they have essentially have created an alternative competitive business model that says, look, you folks are competing, you other exchanges and execution venues are competing on a number of things. One is fees, one is the proprietary data that you're going to be selling, your execution access fees and those types of things. What we're going to be doing is we're going to be making our money, so we're going to charge more. The fees on the IEX to execute are higher than they are in other places, and in return,
a lot higher.
Yeah, but in return, we are going to ostensibly protect you from the other folks who may be jumping in front or the other things that you may see on other exchanges. So that is just a completely alternative business model built within the framework of the regulatory regime in which we live.
And for the audience, how do they do this? I mean, because it's quite ingenious.
Yeah. So what they looked at and what they've done is they've essentially said, look, we're just going to slow everything down, and not by a lot. We're going to slow things down by 350 microseconds. And so what they did is they took a coil and they took essentially what you might think of as fiber optic cable, coiled it up a bunch and said, here's about 38 miles of coil. And in the amount of time it takes information to travel that, it actually slows things down 350 microseconds. Interestingly, it's about the same distance from Cataract to Mahwah, which is
actually it's a little further. 10 miles further.
Yeah.
For the New Jersey connoisseurs in the audience.
Yeah. It's actually not, but so one of the
they
things
said they were going to disagree, but I didn't think this would be it.
So one of the things you actually see is you say, well, that is a delay, and the interesting issue that we'll explore in a little bit is what does that delay mean? Because if they had, for example, they could have said, we're going to set up 2 data centers, one coming in, and we'll set up one 38 miles away. And we're going to make sure everything travels over those things. We actually would not be having this discussion today because I don't think it would have highlighted any of the issues because some venues actually operate similarly to that today.
No, there's a real nuanced difference there, but we'll talk about that later.
Yeah, that's right. But what they did is they essentially in the same place ran this, and now all of a sudden the SEC is faced with essentially a conundrum, and the conundrum is this: they've built an entire regulatory regime focused on price, time, priority. They've allowed for the evolution of practices where information can be shared quickly, although it has to be, if it's an exchange, on an equal basis. So you have to allow co-location for anybody who wants to pay for it, or proprietary data feeds for anybody who wants to pay for it. They've allowed those practices to promulgate, and they have, and understandably so. But how do they fit in this now square peg into that round hole? Is that okay? And that's really what the issue they're faced with now. And we can talk about the details of that.
So how much more does it cost? Because one of the issues that people have raised is it costs a lot more to trade at IEX. What am I getting for this higher cost?
Yeah, and that, I think it becomes the age-old question that we've had. You know, you go back to the New York Stock Exchange, and the old fees were 25 bips, basis points. And you know, that was what you could charge. That was your commission, right? And one of the things we've seen over time, and particularly since decimalization and as well over the last 15 or so years, is explicit, what we might think of as commissions, right, to the broker, have really gone down, and they've now sort of relatively flatlined. What was interesting is we've seen the implementations costs actually flatline, and in some cases now go up. And so what that means is the cost for the investor is not actually necessarily going down. While the commission cost may be, the actual cost of doing a trade on the overall hasn't necessarily. And so what IEX is actually proposing to do is take a chunk of that difference and say, look, we're going to make your implementation costs lower because we're going to essentially protect you from those folks. But there's a fair amount of play there. Now, if you look at the overall execution costs, it may be 3 or 4 to 1. So the implementation costs may be significantly higher than your explicit costs. So if you think about all of that, so the explicit cost is here and the implementation cost is this.
Explicit costs are commissions and fees and things, and implicit cost is the impact of your order has in the marketplace. So if I'm buying, it's going to push the price up. If I'm selling, it's going to push the price down.
That's right. And sorry, I should have clarified that. So you can imagine if that's, you know, now you're looking at anywhere from 60% to 80% of your overall cost of executing an order, there's a lot of room for IEX to say we're going to charge more than another venue where you may have to pay all of that implicit costs, but we're going to charge you more than they would, but your overall execution costs would still be lower. That's where I think the rubber hits the road, because as we talk about IEX, it's a small subset of people, if you think about it, who might be willing to make that decision. So when we talk about IEX, I think sometimes the rhetoric is disconnected from the reality. It's a high cost to execute trades on IEX. So the question is, who's willing to pay that? And I think what we'll see is something where if you were to ask them what their expected market share might be if they were approved, we're probably talking, you know, mid-single digits, you know, and that's over time, because they're not going to be a juggernaut that instantaneously competes, because it's not everybody who is this worried about the implementation costs for their orders that they're willing to pay that premium for the service.
So Larry, it all sounds good. You have people who are willing to pay more to get a different product. That's America.
No, it is America. It's good. No, that is good. And even though the execution cost at IEX is 9 cents per hundred on each side, and overall the net execution cost for the traditional exchanges, I don't know, between 1 and 5 depending upon where you are. You know, IEX charges less for market data and co-location and some of this other stuff. So it's one hand versus the other. So you know, New York just raised their prices on market data a lot. And now there's a whole huge debate about how the exchanges are like gouging everybody for data.
It's like a monopoly, right?
It's a monopoly.
Because
you got to buy it.
Each exchange, because they offer the proprietary data, and because if you are going to be competitive in the trading business, not necessarily the investing business, but the trading business, you have to be competitive with the data you buy. You have to have the proprietary data. You have to be co-located. And in order to do that, well, that's great, but it's essentially they set their own fees. There's not really a governor on that. So what you have is a sanctioned mini monopoly. I'll call it a mini monopoly.
Absolutely.
So that is one of the concerns that we have with the proprietary data feeds.
So it's not it's easy to say, well, 18 mils, 18 cents per 100 here, and maybe 5 over here. There's all this other data fees and colocation costs that come into play too. So it's not as stark as that. But let's get back to the point at hand: milliseconds and microseconds. The challenge with some of this, with slowing the market, as a registered ATS, as a non-exchange, there's a lot more leeway in how exchanges or how ATSs match orders, how they match buyers and sellers, and what they do, and the priority, and the SEC set up Reg S ATS to enable to create competition with the exchanges, because that goes back to the early days when specialists and market makers were arrested for fixing spreads. And so the SEC wanted to create competition. They wanted to create ATSs. They gave them a lot more leeway. They enabled them to match orders in a more not as locked way as the exchanges match orders. So the challenge here comes as IEX moves from an ATS to an exchange. And there are a couple of major rules that come into play. The first is the order protection rule. The order protection rule says that if an exchange receives an order, and remember now there are 12 and possibly 13 exchanges, and if I don't have the best price for that order, I have to send it to the exchange that has the best price. And this is kind of where the speed bump comes in. The challenge is when you're going over that speed bump, your market data, the market data that you're reading, isn't as current as the other platforms. And so when I'm trying to look and trying to say, okay, well, exchange A has this price, B, C, D through 12 or 13, I have to honor these prices. And the problem is, as aggressive orders come into IEX and go over the speed bump, in effect, Ty's order that in effect made the best price at IEX, I won't find out about that if I'm trying to figure out what the right price is. I won't find out about that for 350 microseconds.
Well,
700 in and out, right?
Well, it's 350 each way.
It's 350 each way.
Right.
So I won't be able to see that new aggressive price for Ty's order that came in. So if I'm another exchange and I'm trying to honor my best execution responsibilities and my order protection responsibilities, I don't know that actually I could get a better price at IEX. And the same issue is on the opposite side. Once Ty's order gets executed, it's IEX is still broadcasting that price hasn't changed, even though the price everywhere else has changed. So let's get an example.
Can I?
No.
Okay.
No, I didn't interrupt you.
No. Actually, you did.
A little. So we're in a downward market. Market's going down, 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 down. Okay?
Why?
Doesn't make a difference. Okay, we can go up, but either way, I'm trying to sell. I send an order to New York Stock Exchange or NASDAQ or ARCA, one of the other exchanges. I line up all my prices, and what do I see? Who's got the best price? IEX has the best price because it's the most delayed. Because the market's going down, it's going to have the highest price because everything's delayed. So I am, by regulation, I have to send my order to IEX. But chances are, since the market's going down, that order's already gone. And so I have to send that order to IEX. What's going to happen? It's going to take 350 microseconds to get to IEX. IEX is going to say, oh, that order's gone already. It's going to take another 350 microseconds to come back to me. I have to make another decision as to, okay, well, where do I route it again? Well, again, the market's still going down. I line up all the prices of all the different exchanges. IEX is still the most delayed. It's still going to have the best price. I'm going to send it to IEX again. I'm going to get nothing done, and this is going to continue and continue and continue until either the order gets canceled or the market starts becoming stable, and actually the liquidity is actually there when I go get it. Okay. And so you create these, challenges, with the delays that create problems.
So I'll disagree on a fact here for a moment, because what that assumes is a couple of things that I actually don't think are necessarily always relevant. Well, so one is there is no delay, as IEX has proposed it, to the SIP. And that's really important.
But the SIP is even slower than the direct feeds.
So the SIP is significantly
Timeout.
slower than direct feeds. But
Tell 'em what the SIP is.
Yeah, give me my couple of seconds here.
Okay.
Tell them what the SIP is, and then you can kill them.
So
Okay.
the interesting part there is a number of exchanges and execution venues actually execute off of the SIP. Now, not everyone has to, but a lot of them do. And it is true that the SIP is actually significantly slower than the direct feeds. That's the purpose of the direct feeds, is to provide faster information. That's the value of those direct feeds. So as we think about it, we have the SIP is already significantly slower, and there's no delay to the SIP. So all those execution venues that he's worried about having to route out to IEX are actually not going to do it, because they're going to be they actually are making the decision based on the SIP.
They are not.
As are other folks.
They
So
are not. Most of the execution venues run off direct feeds these days.
Most do, not all.
The New York Stock Exchange does not. That's probably the only one that doesn't these days.
It's not the only one. But those,
Okay.
so that's part of the reason why there is this, and obviously a number of ATSs also have the same issue.
Most of the ATSs run off the SIP.
Not all
No,
of
I
them.
mean, excuse me. Most of the ATSs run off direct feeds.
But
not all of them.
Not all of them. And in fact,
Most of the major ones do.
This was one of the issues we just spoke about with respect to Direct Edge a while back.
Right.
But one of the things from a few years ago, so one of the things we realize is that the difference between the direct feeds and the SIP is actually really significant
It is.
here. And that's the reason, that is the difference between both the proprietary data feeds and why those proprietary data feeds are very valuable, and the reason why they have mini monopoly pricing on them. But it also impacts this exact concern, is whether or not, from an order protection standpoint, there are folks who are going to feel pressured or have to route to a venue where they're concerned about stale pricing. Because again, there are a number of execution venues, NYSE included, as well as a number of ATSs that are still, again, executing versus the SIP, and obviously wholesalers as well. So those types of firms, you would say, well, they're already doing this. So if we also take a look at the SIP, not to go back to our timing, if you talk about 350 microseconds on the one end, 350 microseconds on the back end, maybe a couple of microseconds in the middle for processing and thinking about things, let's just say for a moment where we have 710 microseconds. Well, one of the things that's recently come out is the SIP for at least tape C may be at 900 microseconds. So you're talking about an order of delay that's significantly different. Also, something to point out, not to get too technical on the time horizons, but is the distance between New York and Chicago is a bigger difference than 38 miles, which is the delay you get on the 350 microseconds. Yet we don't see a concern, and there hasn't been traditionally a concern, as to whether or not we would think of Chicago as a stale price. We all think of Chicago as not stale, and that is a protected quote as well. So I just want to throw some things out there.
But
And I just want to remind everyone.
But Chicago exists mostly for trading the ETFs. Because to a certain extent, the E-mini ETF trades in Chicago on the floor of the exchange. And so if you look at Chicago's volume, it mostly has to do with the SPYs and the big major ETFs that trade off the Chicago exchange. And if you look at cancellations, quote cancellations, people throw out numbers of hundreds of cancellations to one trade. Most of that actually comes from Chicago, because the cancellation rate in Chicago is astronomically high. Because again, the delay out to Chicago is much longer than anything else.
So I just remember, the reason this matters is you want the prices to be right from the point of view of having an efficient economy, and the most recent buyer sets prices. And so you want them operating off the right information, and the fight is about whether that's actually happening or not.
Right.
And so would you argue there should never be any speed bump, or is it 350 the problem?
I think the problem with the speed bump is when I'm trying to line up my orders and try to understand who's got the best price, if there's a speed bump, I have a really hard time figuring out what's the right price. And I'm routing to the wrong place. And the other issue with the speed bump has to do, most of the speed issues actually have more to do with how you execute hidden orders, basically pegged orders. Because to a certain extent, if I have a limit order that's priced at 10, that order is going to execute at 10. Whereas if I have a floating midpoint order or an order that's pegged, to the bid or the offer at some place in between, what I'm actually doing is when I find the other side of that trade, I look to the market data, find the best bid, best offer, and then figure out what the price is. That's where the delay happens, and that's actually some of the nuance between actually moving the exchange 38 miles and actually having an intentional 38-mile delay within, or a 350 microsecond delay within IEX, because the market data that actually comes into IEX is real time. That is not delayed. And so the issue, the other issue with IEX is that it has a unique advantage if they become the only speed bump market, in that they actually know what the real bid and offer is, and they actually know what the other exchanges are doing in real time. Whereas the other exchanges will not know what IEX is going on in IEX. So you've got a real competitive advantage, a regulated competitive advantage as to knowing what the best bid and offer actually is if IEX gets approved. Whereas the other exchanges, they're going to get the delayed data from IEX. They're not going to know what the right bid and offer is because it's delayed. Whereas IEX knows what's going on in New York, NASDAQ, Archipelago, and the other ones, and can actually adjust those midpoint price orders properly, which actually, that's a good thing. But the problem is that you're at an unfair advantage here.
Again, I would say a couple of things with that. One, with respect to the order type, or one of the things we've just sort of discussed is something about the discretionary pegs or pegs orders, where it is the order in and of itself is essentially an instruction to say whatever this is, match that, go to the midpoint of that. So that's when we talk about pegged orders, that's what that means. But I would argue one of the interesting things that we want to think about is whether or not that's a competitive advantage. First, I don't think that there's any reason to believe that any particular exchange, if it were to design some sort of similar issue, would have. We always think about competitive advantages. That's the point of a competitive marketplace. So presumably, if IEX were to be approved, there would also be others who could presumably be approved. And now, one of the biggest, actually the biggest concern I have is the manner in which the SEC decides to whether or not they're going to move forward with IEX.
Come back to the process,
and we can come back to that in a minute. But with respect to the order type, the advantage, there's actually nothing when we talk about whether or not IEX, and I'm not sure who at IEX would have some sort of inside information and be able to act upon that based on something that no one else has. The answer is actually no, they don't, because it sits in the time lag, just like everything else. So that's just something I want to say as a careful distinction. And there was a part of their application that actually was a concern that I think what Larry has raised, and actually it's part of the application that was dropped, I think, because of that concern. So I just go back.
So just to hammer the point home, do you think it's okay to have speed bump exchanges coexisting with the current set of exchanges? I mean, again, there could be many IEXs. You have no trouble with that.
Yeah, absolutely. I think it's totally fine. The issue that I have, and is we go back to the reason why there may be concern, is in order to be approved as an exchange, the SEC has to make a number of findings. And some of those findings are promoting fair and efficient markets and not open to manipulation and some of those types of things, and competitiveness. Those types of findings, and I think it's Section 6, if I'm not mistaken, of the Exchange Act, those findings are what I want to make sure the SEC can do. Because there are speed bumps that I can imagine in this world that actually would open the doorway to manipulation, would open the doorway to other problems. And I think Larry and I totally agree on that. And that's where I think the rubber hits the road, right? There are ways that you can envision a speed bump. It's kind of like,
it's
any sort of
It's
tool.
not the speed bump. It's the speed bump interacting with market data.
That's
where the rubber hits the road. It's
And
how
order
the
types.
speed bump operates within, and order types. How it matches, and what happens with what's happening with the market. What's happening? Can I do I see the order before it interacts with the book? So that there's a whole discussion on what they call last look on the FX side of the business, where actually I receive the order before that order actually hits the book, and I can then decide that don't want to trade with that order. That's in the equities markets, that would be really, really bad. in over the counter markets, that's existed forever.
Yeah.
And so there are different types of speed bumps and how they interact with the ability to cancel and change orders and the ability to interact with market data that can actually be beneficial or not beneficial.
And we've seen that from exchanges, right? So Bob Greffield has actually said, yes, depending on what happens right now, if the proposal that the SEC put out with the guidance that we'll talk about in a second is approved, we're going to see a proliferation of order types and business models and fee structures. And I would say that that's a deep concern, I think, for a number of folks who are also very supportive of IEX. So you have this world where you have, I think last I checked, it was over $4 trillion worth of investors in support of the IEX application saying, we are for this. And I think if you polled all of those same investors and say, would you be for a speed bump with these other characteristics, you might get to zero. Right. And so it's not the speed bump, it's how it interacts with other things and what the purpose of that speed bump is.
So let's talk a little bit about the process. Process is always the most fascinating thing in Washington. So IEX applied to become a national exchange. There were lots of comments. It modified its application several times, actually. And one of the things that arises is that in the national markets regulation for exchanges, it says an automated trading exchange, which all these things have become, must execute orders immediately. That's the word that's used in order to satisfy for the sort of regulatory protections on getting the best price and executing orders. So there's this language that says orders must be executed immediately, and we have an exchange that deliberately doesn't by some measure, right? And so one way to decide this would be to just decide it on, it's not immediate, we're done. Instead, the SEC has decided to do an interim step, which is to essentially regulatorily define immediately. How fast is immediate? And that's a process that's undergoing right now. Is that a fair assessment of things?
Yeah.
So what's immediate and what's at stake?
Yeah.
Well, they've pegged immediate at 1 millisecond. And I think the comments around that have been universally negative. I don't think anybody really put in. Maybe one guy put in a positive, issue for one millisecond. but even IEX put in a letter basically saying that they didn't think a lot can go on in a millisecond, and we don't support this.
As evidenced by the fact that people are paying millions and millions of
I want to
dollars
point out, nothing happens in a millisecond.
Yeah, I think it's an interesting point. So you go back to the regulation and you think about what the thought was, and to go back to the New York Stock Exchange specialists, the thought was they basically wanted to say we want this to be automated and not have a human interject. That was the thinking. Right. And in the interim,
they define immediate as kind of a second. For trade through, immediate is defined as a second. Clearly, right now, a second is an eternity.
Yeah. So if you think about it as, we just don't want to have a human interject themselves, and that was their thinking with immediate. Right. And in other places, they said a second is kind of where we think it should be. They've never actually addressed it here. Now, they could have, because obviously it is the case that there is Chicago and there's a delay there and back, as we've talked about. And there are obviously with other exchanges. So it's something that has always been, for lack of a better phrase, an opportunity for clarification. But now that you have the element of, I am intentionally winding this cable and dropping it in a box somewhere, my black box, it makes it a very significant question, because now you have to call into question what that means and why. And I think when we think about what a millisecond is, just the mere fact that folks are willing to pay millions of dollars a year of monopolistic pricing in order to have access to speed and co-location and better data, it's clear that millisecond is obviously not de minimis, right? And which is the word the SEC used, is de minimis. And so setting that aside for a minute, then the question is, well, what does immediate mean and why does it matter? So the SEC now has to, I think they have determined, at least in the proposal stage, they propose to redefine immediate with this de minimis. They could, as I see it, they have a couple of opportunities with how to move forward. They could just leave it the way it is and deny IEX and say, look, we think it has to be immediate. You're not immediate, and they could just deny. They could say, look, it's not immediate, but we think it's close enough. And they could say, but we're going to do a rulemaking, or we're going to do a revised interpretation. So we're going to approve you anyways, but we're going to do a new revised interpretation, or we're going to do a rulemaking. Either one, those are possible. Again, there's some litigation risk associated with that. Or they could say, gee, we're going to change our interpretation, which is what they've suggested they would do, and most likely approve IEX based on that interpretation. Or they could come forward with a whole rulemaking. Because now, if we think about it, this is a really big deal. And so that's a possibility as well. So those are the options that the SEC has at its disposal. If you were to ask me what I think is most likely, and maybe you might
just
disagree.
about to ask you.
But I think of those options, I would be surprised given the number of times the SEC has delayed the application. I think IEX probably thought they'd be approved a long time ago. But if you were to ask me what I think is the most likely, I would say take my hat off as a former SEC Commissioner's Counsel and just say, Ty, sitting here, I would say it seems likely that the SEC would revise its interpretation to the guidance and say, look, we're going to say that this 1 millisecond is de minimis. I'm not entirely sure why, but we're going to make that up. But we're going to add some level of investor protections to that. So we're going to say not only are we dealing with the 1 millisecond de minimis, but we're also going to say, rather than just no regulation after that, so free for all and with less than a millisecond, we're going to say that the Exchange Act applies and these types of things have to be found. And we're going to put some other layers of protections for investors to make sure that it's not what I might call a manipulative or a bad speed bump order type combination.
So before I ask Larry if he likes that idea, if IEX didn't have a pending application and the clock hadn't been ticking, is that what you would suggest they do?
Actually, yes, I do. Although I would like for them to have done that before. I mean, I think that this, as I said before, this is an issue that they could have addressed 5 years ago before IEX was even thought of. And frankly, I think was actually a ripe discussion point in 2010 when people were worried about proprietary data feeds and flash orders and some of the things that, came into the news in May, plus or minus May 6th, May 7th of 2010 when there was a flash crash. When we start thinking about those things, I think that it would have been nice for the SEC to have been proactive here. Unfortunately, they're being reactive because they now have a pending application.
I unlike Ty, don't know what's going to happen. I think they're between a rock and a hard place. I think Ty's what Ty recommends is I think they probably will greenlight IEX. They'll figure out some way how to do it. I'm not sure how they do it without getting sued. So what Ty says may actually happen. On the other hand, they could get denied. I think they probably won't. So I think either they figure out some way of figuring out, maybe it's not a millisecond that's de minimis, maybe it's 350 microseconds becomes de minimis,
It's a little too obvious then.
Whatever. But I think it does wind up getting approved some way, and I think and the next issue will be is that I don't think that'll be a good thing. I think that having the level of speed bumps, first of all, creating one speed bump creates a problem, but it's an understandable problem. If I know that IEX has 350 microsecond speed bump, I can deal with it. The problem becomes is there are 7 exchanges that have under 5% market share. So all of a sudden, within 3 days later, you've got 7 other speed bumps with those exchanges that occur. And then even within the larger exchanges, you wind up with order types that that have different speed facilities, and you can wind up with ranking mechanisms to say if you pay me faster, you get a bigger speed bump, or you can interact, and you wind up with a complete mess on your hands trying to understand what's the best price, where do I route, how do I get from here to there, and how do I take care of all your guys' orders and get the best price. And to a certain extent, what I would actually much rather see is go the opposite way. Get rid of locked and crossed markets. Get rid of the order protection rule completely, because in reality, what you really want you to do is get the exchanges out of the get the exchanges focused on figuring out how to match buyers and sellers together better, and get the brokers to invest in their infrastructure to get them to manage your orders better. And if you don't, and get better transparency to make sure that your broker's doing the right job. And if they aren't, fire their ass.
Yeah.
And the problem is that the amount of data that's accessible to most investors, even the most sophisticated, and I have a whole business, based upon trying to understand routing data, is really, 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 really hard to find. And so it used to be, okay, I used to say, well, look at your TCA and figure out who's doing a good job, and you reward them and penalize the other guys. The problem is that it's really, really difficult, if not impossible, to do that. And the problem is, let's have better transparency, let's have better data, have access to information, and hold your damn broker accountable and responsible, and get the whole exchanges out of this whole business of figuring out, if you have the best order now, you have the best order,
This is one of those moments where I violently disagree or violently agree with Larry. And we've actually said that in our comment letter on the IEX.
Us violence.
Yeah. On the IEX application, one of the things we said is, we didn't think it would be fair to penalize them versus other exchanges with respect to routing, but it is something that we are concerned about. I mean, at the end of the day, you have two different businesses. One is you're in the business of routing orders, and then you have, best execution obligations. And the other is I'm in the business of matching buyers and sellers. And those may not be the same thing. The metrics of how well you perform at your job are also not the same. And they may be in direct competition with one another at times. And so one of the things I think we worry about, particularly when you look at even at the data, is that when an exchange routes an order away, how do you know what happened and what data gets reported there? There's
tremendous disincentives for even the exchanges to route properly, because at the end of the day, they actually want to match the order. They don't want to route it.
Yeah, and the best execution obligation isn't, while it's being routed out by the exchange's broker-dealer, the reporting of that and the measurement of that is actually not necessarily very clear. And so that is one area where I think we are equally concerned. I would like to focus, venues are venues, execution venues are execution venues, and brokers are brokers. And it may be in the ATS space that they happen to be the same thing, but you really want to think about separating those business lines.
I agree wholeheartely. And a lot of the order, everybody's been, fussing about, these order type complexity and all this other stuff. 90% of the order complexity comes from all these issues around locked and crossed markets. Basically, when the price, a locked market is when the price on the bid and the offer is the same, and a crossed market is when the bid is actually above the offer, which is reversed. And a lot of the ATSs actually get into all sorts of problems with execution when the markets are locked and crossed, and they have bizarre logic in there. But that said, this whole idea that you can't trade when locked and crossed markets, and you have all these complex order types, like if an ARC is locked, then if ARC is here and BATS is here, then I can't do this, and I got to hide it and then slide it and do this and do that. A lot of this has to do with the locked and crossed provisions, which should just go away.
When we talk about complex order types, one of the things is they're complex statements. They're compound statements. It's essentially saying, if this happens, then do this. Right. If not, then go over here. And then if not, go over here. Those may be routing instructions as well. Right. And so when we talk about the complexity, a lot of it has to do with you've now made what I used to think of as a limit order, right, is now a limit order with 7 conditions or qualifiers and a priority of those things. And that's really where some of the complexity of the markets comes from.
Right. We're going to allow the audience to ask questions. If you have a question, raise your hand, wait for the microphone to come, identify yourself, ask your question in the form of a question, and direct it to the member of the panel.
Hi guys, Patrick Temple West with Politico. Both of you mentioned litigation regarding the IEX application. Litigation lawsuit by whom?
Yeah.
I think the issue is that depending upon what happens, if IEX gets denied, I would assume IEX is going to sue, and if IEX gets approved in some sort of I don't know, it doesn't seem like it's a fair ruling that okay, we like these guys, so we're just going to approve them. I would assume that you're going to see some other exchanges or possibly market makers or whatever sue.
Yeah, I'll jump in. So I think with IEX, they've now got a lot invested. So if they were to be denied, it wouldn't surprise me at all if they brought suit. And I think they've sort of made grumblings about that to folks. With respect to what a lawsuit, if they're approved, I actually think the lawsuit might not necessarily be with respect to their approval, but it might be with respect to the guidance or rulemaking upon which that approval might be conditioned. And in particular, one of the things we've seen with a lot of rulemakings is cost-benefit analysis or those types of things. So, there are a lot of legal avenues that folks may say in terms of, is this, if it's guidance, is this something that should have been a rulemaking? Or if it's rulemaking, is there adequate cost-benefit analysis? Obviously, for guidance, there doesn't, the requirements are different. So it wouldn't surprise me if folks say, look, if the SEC conditions essentially the approval of IEX on the simultaneous or immediately subsequent or immediately precedent adoption of guidance or rulemaking, someone to go after that as the mechanism, as opposed to necessarily the approval. We also, on the counterpoint, the reason why there may not be litigation here is something he mentioned earlier, which is the opportunity for others. I think we were actually both quoted in the press in the same story on the same side, which was there is an opportunity for other exchanges here. So depending on what that guidance or rulemaking looks like, if there is one, it would not surprise me at all to see others, and in fact there's rumors that others are currently exploring this opportunity, figure out ways to design their own delays, their own order types, and those types of things as a competitive response to this.
Yeah, I think if IEX winds up getting greenlit the way it is, I think within a year we'll have. Actually, I think I have odds, maybe 4 or 5 different other speed bump markets.
You and I have a bet, although I don't remember what it is.
I don't remember what it is either,
Yeah.
but I think we're going to wind up with other speed bumps. And I'm writing a piece on speed bumps now, and it's surprising actually. Each one I've looked at is actually a little bit different. So you've got one called NEO in Canada that doesn't allow the speed bumps only IOC orders, basically immediate or cancel orders. They tend to be more aggressive. You've got Aqua that has a different type of model that it's actually it gets into all sorts of details. There are auctions that happen in some of these pauses that like PDQ has auctions, and the Chicago Exchange is going to do auctions within a speed bump period of time. The FX guys have different speed bumps as well. Some of them are random. One guy's randomized. Another one. They actually won't talk about it because I think they're possibly in litigation around it. So they're basically each speed bump you look at has actually has a different actual flavor than the other ones.
Yeah, and to go into the speed bumps for a second, there are a lot of policy choices. So if the SEC gets into the speed bump world and they elect to do this, there's going to be future stuff. This whatever guidance or rulemaking or whatever they plan to do here, or even if they do nothing, they're going to end up having to do guidance or rulemaking in the future because they are going to be presented with a number of other questions. Because not just for this, now they will have approved IEX. So assume they do nothing and yet they approve IEX, which is a possibility. The next exchange application comes in, and let's just say instead of being 350 microseconds, it ends up being completely randomized. Well, what sort of questions does that pose from an investor protection standpoint or a fairness and efficiency of the markets? How do you know how that works with the proprietary data feeds and the use of the SIP for matching and routing purposes?
So let's take one step back, one second.
Yeah.
So what the hell is this speed bump for? The speed bump actually is for actually protecting the guy, displaying a limit order, the guy who's actually providing liquidity. So the challenge is that if I put in the market that I want to sell at the midpoint or sell at 20 or whatever the price is, what generally happens is you've got actually multiple order books. As I said, we have 50-something or 60 order books if you include everything. Really, where speed comes into play is actually at the worst price, at the highest rebate exchange, because that's going to be the last place I go, because the highest rebate exchange is where it is also going to probably have the highest take fee. So it's going to cost me the most to take that liquidity at the last place. So I'm going to go to every place first before I go to the expensive place. Speed is actually has to do with managing the book queue at the worst venue, because it's where I'm going to get paid the most for my liquidity, and it's going to be the next stop after the worst price limit order at the highest rebate market is the next worst price, because there's going to be adverse selection almost 100% of the time in that venue. That's what speed's important for, is to manage the queue priority in the last venues. And so the challenge is, if I'm displayed in that venue and I'm the last guy in the last place, I'm going to get screwed every single time I trade. And so this speed bump, what it's there for is to insulate me, from being picked off when I am the last person. It gives me, the high-speed guys are not going to go there because it's going to take 350 microseconds to get there, and I'm not going to be picked off at the very end, and the next trade's going to be, worse than me. So the speed bump is actually to protect the person providing liquidity. And actually, in IEX instance, most of those folks actually are HFT guys. Most of the folks providing liquidity in IEX are actually providing liquidity at all the other exchanges. And that's what they do for a living. They provide liquidity. So it's very odd, that's actually, this whole idea that it's, a long-only mom-and-pop guy, providing liquidity over 4,000 symbols in IEX or someplace that's generally not the case. What they're protecting actually is from being picked off when you're actually providing liquidity.
Yeah, but that's also part of the reason why you've seen the algorithmic trading community, instead of just HFT, I'll call them algorithmic trading community, have divergent views on IEX's application as well, because they have different business models. So on the one hand, you had Virtu in support of it, and on the other hand, you have a number of other algorithmic trading firms based on the business model.
Let's go here.
I'm Dave Michaels with the Wall Street Journal. I have a process question for Ty and maybe more of a strategy question for Larry. So I didn't quite understand on the process. Is the interpretation a predicate for approving IEX? That is, like, if the commission has already articulated this idea of what's a de minimis speed bump, and you said they've gotten a lot of negative comment letters about it, and they say, no, we actually can't implement that. We get crushed, and we're not going to do it. Can they then, absent that, approve IEX, or is not moving forward with the interp mean that there's got to be some kind of delay for IEX?
Yeah. And
then my strategy question is more like, okay, so if all these other exchanges move to implement speed bumps, like Greifeld said, what's the value of IEX? Why'd they waste all this time trying to get approved if you've got 4, 5, 6 exchanges, all with some variation of speed bump, and IEX then is stuck at 1-2% market share? Like, why aren't they just an ATS then?
Yeah, so I'll start with the first one. Process-wise, so the SEC did not expressly condition its approval of IEX on the adoption of guidance. However, they did those things simultaneously. And it was relatively clear from the language of the proposed guidance that they, at least at that time, were thinking they would have to change the guidance in order to approve IEX. And I think a number of folks read into that, they're going to change the guidance, and by changing the guidance, that's going to greenlight IEX. I think most people drew those conclusions. The SEC has not expressly done that. So I will just say they could, in fact, and one of the things actually we urged them to do in their comment letter is to separately evaluate, bifurcate it, and say, look, this is now clearly an issue. It's been an issue, by the way, for long before IEX's existence, how to define immediate. But now, especially given IEX, we're going to look at this guidance, or we're going to adopt a rule, and we're going to do cost-benefit analysis. They could do that completely separate from IEX. So I don't think it's necessarily condition precedent, but it seems, at least from the way they framed it when they released the guidance and they made the decision on IEX to essentially delay it for the next several months, that is where they're going. And further, it would suggest that the IEX application would be denied unless something was changed. Again, they didn't say that. That's the reading most folks took into it.
There's some other political stuff going on too that may be in the loop here too. The way that the SEC votes is that they need 3 positive votes to approve something. There are only 3 commissioners, and so there may be some sort of rift or split within the commission that basically is forcing them to postpone, or delay the vote, because if they bring it to vote now and one guy or one girl decides that they don't want to vote on this, then they can't really vote, and so they may be, so they may actually need 5 people to actually get this forward.
So in order to get the guidance or a rule, right, you have to have all 3 commissioners essentially not just agree that it's the guidance or the rule, that the route, which way to go, but they also have to agree that that's the right outcome.
Way. So if it's a 2-1.
So you could imagine a world in which you say, I agree that we can do this via guidance. And so you have all 3 commissioners agree on the guidance, and they could say, all right, well, we think it needs more protections. So it can't just be open-ended de minimis as they originally suggested. We think it should have, one commissioner could say, I think it needs these 3 protections. Another commissioner could say, I think it needs 6. Well, then how do you necessarily resolve it? Further, you could have a big distinction between is it guidance or is it a rulemaking? And if it's a rulemaking, you can imagine that someone would say, Commissioner Pivavar used to work at what used to be and is now the economic arm of the SEC. You could imagine he would say, look, I think we need a thorough cost-benefit analysis. I think we need to know
data.
economic impact. Right. This change may be significant. I don't know what his thinking may be, but you could imagine a world in which this thing gets slowed down significantly because you need unanimity on both the path forward but the precision of how to address the substance.
Time is running short. One more question. If not, join me in thanking Ty and Larry. Thank you.
Yeah, thanks.
Thanks, John.
As always, sir.
Doug?
Well done. Thank you.
Thank you.
Hey, thanks, Doug.
Thanks. Really
Really
appreciate it.
appreciate it.